Moving on to 7.5, apply gap for natural resources and intangible assets. Natural resources, these are long-term assets such as iron ore, petroleum, or what we know as oil, and timber. And we don't depreciate natural resources, but they do deplete over time. And the depletion tracks the flow of natural resources from its raw state through inventory to cost of goods sold. So when we purchase, the original purchase of an oil reserve, as an example, in this example here, suppose ExxonMobil buys an oil reserve for $100 million, and the reserve contains an estimated 10 million barrels of oil. So the initial purchase of $100 million would be a debit of $100 million and then a credit to cash. So if we look on the impact to the accounting equation, this would be a debit to oil reserves for 100 million and a credit to cash for 100 million. Okay, so that's the purchase of the oil reserves. Think of it, essentially they bought the rights to some reserve that is sitting underground that they can now put these pumps in and start taking the oil out. Now, the depletion rate is $10 per barrel. Now, how did they come up with the depletion rate? Well, they are estimating 100,000 barrels of oil. So the depletion rate is going to be computed by taking cost of the reserves. In this case, it's going to be $100 million. And we're going to divide that by the estimated barrels of oil. So barrels of oil, wow, that's bad. Estimated barrels of oil, and that's 10 million. So the rate, as you would guess, dollar per barrel is going to be 100 million divided by 10 million, which is $10 per barrel. That's how they computed it here. The depletion rate is $10 per barrel. If 3 million barrels are extracted and 1 million are sold, the following entries are made. So the first thing we're going to do is debit oil inventory. For how much? For 30 million. That's the 3 million times $10 a barrel. Let's go up to our journal entries. So this is the oil reserve, but we have another asset called oil inventory. And let's call this B, and we're going to debit it for $30 million. We're going to credit oil reserve for $30 million. And the way we came up with the 30 is because we took 3 million barrels out at $10. 3 million barrels at $10, 30 million. So the debit to inventory and the credit to the oil reserve. We took it out of the reserve and put it into inventory. Then it goes on to say that we sold and 1 million are sold. So 1 million times the original cost of $10, 1 million times the cost is $10 million. So that's going to go to the cost of goods sold, and we're going to credit the oil inventory for 10 million. So, so under equity as an expense, there's going to be the cost of oil sold. We're going to debit the cost of oil sold for $10 million. And then we're going to credit oil inventory for $10 million. Okay, so the balance in oil inventory is going to be 20 million. You can see that debit minus the credit, there'll be a balance. Let's go ahead and put the balance there. Intangible assets are long-term assets with no physical form. They carry special rights. So the examples of intangibles would include patents, copyrights, trademarks, franchises, leaseholds, and goodwill. There are two categories of intangible assets, and they are finite lives, and in that case, finite lives are amortized over their useful life, and indefinite lives. We do have to check them periodically for impairment. So the first thing we'll look at is a patent, and the patent does have a finite life. The patents are granted by the federal government, and they give the holder exclusive right to produce and sell an invention of some sort, and they last for 20 years. This patent will last for 20 years. Now, the amounts that go into the account are the costs that are incurred for the patent itself. If you create the patent, then it's the cost of the attorneys and the registration fees. It's really not a whole lot of money. But you can, if you create the patent yourself, if the company creates the patent, then it's just simply the cost associated with obtaining the patent, which is not too expensive. Likely going to be less than $20,000. But in some cases, as in the example we're here, suppose Sony pays $170,000 to acquire a patent on January 1st. In other words, Sony didn't create the patent, they're acquiring a patent. Somebody else made it. Maybe they're an individual or another company, they're just buying the patent from another company. And they acquired it on January 1st, and the business believes that the useful life is going to be 5 years. Now, even though patents have a 20-year life, it could be that its useful life is a lot less. So what they're thinking is that, well, nobody can duplicate what I have. I have a patent on this. But there's a good chance that it'll become obsolete. Somebody will come up with something even better, or a different process, or a different machine, or whatever it may be that you're patenting, that somebody comes up with something else, and so therefore it's not really going to have any useful life after about 5 years. So that's what their determination is that I'm going to pay $170,000 for this patent, which will give me about a 5-year useful life. So they're going to debit patents for $170,000, and they're going to credit cash. That was the acquisition of the patent. Let's go ahead and see how the T accounts are impacted. So in this case, we'll call it A. They purchased a patent, $170,000. That's the debit, and the credit to cash for $170,000. Since they believe it's going to have a useful life of 5 years, then this is going to be exactly like straight line depreciation. We're going to go ahead and compute how much per year we need to write this off. So $170,000 will cost $170,000, and we're going to divide it by its useful life, which is 5 years. So the annual amortization is going to be the cost divided by the useful life. In this case, it's going to be $34,000. So the journal entry is going to be a debit to amortization expense for $34,000 and a credit to patents. There's no accumulated amortization. You simply just go against the patent itself. So if I want to record this, we're going to have amortization expense here under equity. Amortization expense. We're going to debit it for $34,000. Say that's B. And we're going to credit the patent $34,000. So the balance after that journal entry is going to be $136,000. Okay, another intangible includes copyrights. Copyrights are granted by the federal government, and they give the holder exclusive right to reproduce and sell either a book, musical composition, film, or other work of art. This will extend 70 years beyond the author's life. So if you create a song that becomes a big hit, before it becomes a big hit, you better have a copyright on it. You register it, you have the copyright, and you can hold that copyright for your life completely. Then once you pass, it transfers to your heirs, or maybe you sold it before you passed, and whoever holds it that can continue to have value for up to 70 years after you've passed. What I always wonder is like if a group creates a song like the Beatles, I would imagine that the entire group made some of their music. And if somebody purchases the copyrights for the Beatles music, which I think Michael Jackson did back in the day, and I don't know if it's just still part of his estate, but how does that work in terms of how long it lasts? Is it wait till the last, I bet it waits till the last person passes. And Paul McCartney, I think, is still alive. So we haven't even started on the 7 years. Trademarks or trade names, those are a distinctive identification of products or services. Useful life may be set by a contract, and if it is, then you'll use the same computation of the way we did the patent, and it's amortized over its useful life. But if it has an indefinite life, then you don't need to amortize it, but you do have to check for its value over time. Franchises and licenses are granted by a private business or government. It is giving you the right to sell a product or service in accordance with specific conditions, and includes a restaurant chains and sports organizations, and often have indefinite lives. So if you buy a franchise, you do not amortize that cost. You simply hold it as an asset until you sell that franchise in the future. Goodwill is a little bit of an interesting concept. What Goodwill is specifically is the excess of the cost of purchasing another company over the sum of the market values of the acquired assets, which seems a bit awkward, but it actually is very true. It happens all the time. What we're talking about is a situation where you see that there's a building. Let's say, as an example, there's a local store that is on the corner of, let's say, right across the street from the Tulare COS Center. That's kind of out in the country, so that's still developing. So let's say right across the street from the Tulare COS Center, there is I think there's a market there. It's like it's a little small store. And that owner decides that he or she wants to sell it. Now, if you take the fair market value of, let's say, the land and the fair market value of the inventory and of the building, you may come up with, as an example, let's say $300,000. Now that owner decides he or she wants to sell it. So now the buyer goes in and the buyer says, you know what, that location has a ton of potential. Why? Because it's right across the street from the Tulare COS Center, and if you project out into the future, you may think, you know what, that has a lot of potential because that Tulare Center is going to grow. I mean, that may or may not happen, but you may make that assumption if you're looking at a business investment. So even though the fair market value of those assets on that corner are only $300,000, the seller knows about the Tulare Center, so he or she may be asking for $500,000, and you may agree to that. And if you do agree to it, well, the fair market value of the assets are $300,000. You paid $500,000. That means you paid $200,000 more than the fair market value of those assets. That's goodwill. Let's go back and look at it. The excess of cost of the purchase of another company over the sum of the market values of the acquired assets. So the acquired assets that I told you was $300,000. We purchased it for $500,000. That difference is considered to be goodwill. Goodwill is only recorded when it is purchased, and this is something that is not amortized. It's only written down when there's an impairment. So as an example, let's say you bought that store right across the street from Tulare COS. The store is doing all right, and then Tulare COS shuts down. That's not going to happen. But hypothetically, let's just pretend that you bought that store across the street and now the Tulare Center just shut down. You might decide at that point in time that that goodwill, that $200,000 that you have on your books, is not there anymore because the Tulare Center went away, right? That would be an impairment. And when that occurs, you have to make an adjustment. So let's take a look at a specific journal entry that might occur. FedEx acquires Europa Company for $10 million. Europa has assets with the market value of $9 million and $2 million in liabilities. Therefore, net assets, that's the fair market value minus the liabilities, is $7 million. FedEx pays $3 million for goodwill as follows. Europa has assets of market value of $9 million and $2 million of liabilities. That means it only really has $7 million in market value. FedEx paid $10 million for it. Therefore, $10 million is $3 million above the fair market value. That's how we figured it out. $10 million was the total amount paid. $9 million was the fair market of the assets, but we're going to reduce that by the $2 million in liabilities that were acquired. So that means the net assets value is $7 million. 10 million minus the 7 gives us the 3 million. So when we actually purchase it, we're going to record all of the assets that were acquired and their values at cash, receivables, inventory, plant assets, all at market value of $9 million. We're going to record the liabilities of $2 million as well. So $9 million is debited. Credited, because we're acquiring the liabilities as well, as $2 million. So we owe that $2 million. We gave up cash of $10 million. So on the right side, we have $12 million of credits. We only have, so far, we only have $9 million in debits. Well, that's where the $3 million comes in for goodwill. So the way this looks for the purchase, so the assets acquired are $9 million. The cash we gave up was $10 million. So let's call this P for purchase. Yeah. We're going to recognize liabilities that were, these were loans, liabilities that we took on by the purchase, by the nature of the purchase of $2 million. So $9 million of assets acquired, $2 million of liabilities that were also acquired. The net is $7 million. We gave up $10 million. We need our difference to be $3 million somewhere. So where's that going to be? That's going to be an asset called goodwill. And that is going to be P, just like this should be P as well. $3 million. Okay, so that's how that would look on T accounts. Looking at accounting for research and development, R&D. Research and development are costs incurred to develop and create new products. Most valuable activity many companies engage in. That's because, without the R&D, they're not going to be able to develop new products. U.S. companies do not report R&D costs as an asset on the balance sheet. And so GAAP requires that R&D are classified as an expense, and they go to the income statement. Now, the reason why we're real careful about saying this, that U.S. companies, U.S. GAAP, because international standards allow companies to capitalize their research and development costs. U.S., they do not. That's one of the major differences between GAAP and IFRS, International Financial Reporting Standards,